Good morning and a warm welcome to the Trobe Financial Investor Call for October. I'm Bridget Crowe, Head of Corporate Affairs at Trobe Financial. Thank you for joining us today. During our presentation, your lines will be in listen-only mode. I'd also like to remind you that the webinar will be recorded. We've had a number of questions sent to us ahead of time, and we'll try to address these questions throughout the presentation in the relevant places. We'll also take questions at the end of the presentation if time permits. To submit questions at any time during the presentation, please click on the Q&A button at the bottom of your screen. Please note that we won't be able to speak to individual account questions in this forum, but our investor team is always available to take your calls and questions on 1800 818 818. I'll now hand over to our Chief Investment Officer, Chris Andrews.
Thanks, Bridget, and good morning to all joining our October investor call. To assist with our presentation today, you will be hearing from three of our most senior wealth management executives who will share with you their thinking and their insights. Annie Sestito, our Head of Platforms and Investment Operations, is a 20-year veteran of banking and wealth management. Annie has an MBA and has held a range of senior positions with St George Westpac, ME Bank and AXA. Troy Stratton, our Deputy Chief Investment Officer, likewise has 20 years of experience, both offshore in London and here in Australia, across banking and wealth management. Troy has worked in very senior roles with Barclays Bank and HSBC Wealth and is a chartered accountant. Michael Watson, our Head of Distribution for the Asia Pacific region, is a decade-long veteran of Trobe Financial and is very well known in that capacity across Australia's wealth and financial advice industry. Also with an MBA, Michael's previous roles were in banking and non-bank financial institutions as a specialist credit analyst. So he's really well suited to take you through some of the key portfolio issues that we're thinking about today. So on that note, and remembering that some of you are joining us for the very first time, and a big warm welcome to all first-time attendees at our investor calls, I'll ask Annie Sestito to give you an update on the company. Annie, good morning.
Good morning, Chris, and good morning all. It's great to join you on the October investor call. Trobe Financial has been recognised as Australia's leading credit and wealth manager, really since we commenced operation in 1952. There are four key things that all clients and partners know about us. First, we source our investment grade assets from the $2.5 trillion residential and commercial mortgage market. This market is 33% larger than the Australian Stock Exchange, and this gives us a rich opportunity to select high-quality investable assets for our portfolios and for you, our investors. Second, we have genuine scale in the market that allows us to execute on opportunities and to develop real-time proprietary insights into those markets. We originate $11.4 billion of investable loan opportunities each year and manage funds for 48,000 investors covering some of the world's largest and most sophisticated banks, financial institutions, and fund managers. Third, we have designed Trobe Financial for all economic cycles and are in fact building a fortress balance sheet, as our Chief Financial Officer, Martin Barry, outlined last month in summarising the FY20 group annual results. Importantly, for investors, we build our business like we build our portfolios, to be resilient in times of market volatility, and that has certainly been the result through COVID-19. Finally, we have a very strong share register. We are a portfolio company of the New York-based Blackstone Group, who have over US $564 billion of assets under management globally. Blackstone has deep expertise in credit and property and a relentless focus on investment discipline that is complementary to our own. Next month, we hope to bring you a presentation with executives from GSO, Blackstone's international credit arm. Through this structure, we continue to build a deep reservoir of trust with our investors, and we have genuine conviction in the ongoing resilience of our strategies across all market conditions. If we turn to the next slide, you can see that we have a deep and experienced bench of executives, as you would expect of an organisation of our size. Our leadership team is as high quality as any in the industry. Over the last few investor calls, you have heard from our Chief Financial Officer, Martin Barry, our Chief Lending Officer, Corey Bannister, and our Chief Operations and Risk Officer, Rowan Donoghue. We will continue to introduce investors to our executive ranks via these investor calls to validate our view that you have at your disposal an exceptional team with broad and deep skills to manage your money. This next slide shows objectively that asset quality continues to lift measurably and materially as our business has grown. That is, we are not sacrificing quality for growth, and it is by design. It's a purposeful response and proves the benefits of our consistent performance and active management. The chart on screen shows that in June 2016, prime and super prime assets, the highest quality loans we invest in, were 28.2% of the portfolio. 4 years later, that has grown to 38%. That's up 32%. Similarly, the higher yielding but riskier specialist assets were 19.1% in 2016. They are now 9%. That's a 50% reduction, evidencing our de-risking of the portfolio as we grow. For almost 7 decades, we have toiled at protecting investors' capital as our first and almost exclusive duty. This has meant that ongoing contribution that we make to lives and to families via job creation and provision of capital to so many individuals and businesses around the country is substantial. In lending some $28 billion cumulatively since 1952, our cumulative GDP multiplier additional to the Australian economy is approximately $79.8 billion. We are very proud to have assisted the economy so materially, especially at times like these when so many are finding the going very hard. We can assure you, on behalf of the entire private wealth management team and the 400 staff, that we are focused on continuing to deliver tremendous performance and the highest standards of friendly personal service through this period. On that note, I will hand over to Deputy Chief Investment Officer, Troy Stratton, to take you through some of the key portfolio investment positions and metrics for this month.
Thank you, Annie, and good morning, everyone. Our October portfolio report for September month end is on our website and freely available to our investors and advisors. It gives an incredibly detailed overview of the portfolio and how our portfolio managers have positioned funds invested to perform through the month of September. Now, during the month of September, the portfolio's management continued to perform above benchmark. This outperformance resulted in all account options making monthly payments of interest on all investors, and all request redemptions at maturity were met in full. This again is a consistent outcome since inception of our funds management operation back in 1990. The consistency of performance can be shown in the graph on your screen, which shows the performance of $100,000 invested in October 2002 across a range of asset classes. The dark blue line is cash, green is property securities, light blue is bonds, red is global shares, grey is the Australian share market, and classic account notice is in purple. The thick orange line in the middle is the 12-month term account, which started in October 2002, some 18 years ago this month. The return that it has delivered has been very strong, even in absolute terms, across the 18 years or 216-month period in which it's been operating. Its performance is also incredibly consistent, low level of volatility. It simply keeps on performing month in and month out and producing monthly income yields above market for our investors. That's important because it takes the question of having to correctly identify the time, entrance, and exit into the market. At timing difference, the real difference for most asset classes, if you invested in the Australian share market in 2007, you immediately incurred a substantial capital loss. And in fact, your portfolio is still down around 10% today, some 13 years later. By contrast, our classic 90-day, 12-month, and 4-year accounts continue to have their flawless track record. None of these accounts have ever lost a cent of investor capital or missed a distribution. None of them have ever failed to pay an investor redemption at maturity. That's the performance profile we have designed over 7 decades for our investors. The asset quality dashboard now is a selection of key metrics from our monthly portfolio report that speak to the quality of the underlying assets in your portfolio. You can see the portfolio average loan to value ratio is around 63% across the fund, are very conservative. Consequently, our investment portfolios are not as exposed to changes in market prices and have an ample buffer of capital protection built in. They are less volatile than equities markets, and we build in a significant margin for safety. We like highly diversified, granular investments. So you can see from the average investment size on screen, just 522,000 in a 3.5 billion 12-month term portfolio account. Our experience has shown that similar loans are much more robust in market volatility. We require quality borrowers as the key metrics as the table shows. 90% plus of the borrowers in our portfolio have zero credit events in their credit history. 91% of the portfolio is in the metropolitan location, which avoids the volatility that can be seen in more remote geographies, and we have a measured mix of sectorial exposures too. You will note that we've also included a 4-year account, which invests in RMBSs and warehouse structures. These data points show the underlying loans in the 4-year portfolio. That every borrower applicant we obtain a detailed credit history report from independent credit bureau Equifax. The data on screen from Equifax summarises the cash screen of the Trobe Financial borrowers applicants updated to the end of June 2020. And I'd like to make 3 points. Firstly, our borrowers are objectively a very high quality cohort. You can see that from the top right-hand graph. A score of 833 plus is an excellent credit score according to Equifax, and you can see the very high proportion of our fund that is within this level. This dynamic of very high quality borrowers is supportive of resilient portfolio performance. It's a key contributor to the strong recovery we've seen in our hardship loans, which Michael Watson, ahead of our distribution across Asia Pacific, will speak about soon. Secondly, the credit quality of our applicants is visibly improving over time. Witness the top left-hand graph. The blue line on the top left-hand side graph goes to explain this further. This, of course, is a confirmation of Annie's earlier comments about the ongoing improvement in borrower credit quality in our portfolios. And finally, the credit quality of our applicants is materially above the peer average. That's perhaps not surprising, given our reputation for conservatism in our lending program, which is hardwired into our credit assessment and portfolio management selection processes. Our portfolios are subject to independent review by 5 of the Australian leading independent rating agencies. That is an important validation of our portfolio decisioning, our construction methodologies, and our performance. Across each of these agencies, we hold the highest rating in the sector for various offerings. You can see all of these ratings on screen, and each of these are available on our website. All of that has resulted in a host of global and domestic awards for excellence in our asset class. For us, that's confirmation that we continue to lead the industry in the disciplines with which we select our assets and build our portfolios for investors. It is something we are very proud of at La Trobe. Most of all, it speaks to the long-term track record we have delivered for our investors. Our liquidity management practices is also an important part of our performance track record. Those of you who attended these updates previously will be well aware that we took our short-dated accounts to overweight cash position while markets were volatile in March, April, and May. Our classic notice account was holding close to 90% cash through that period. Consistent with our guidance over the last few months, we have commenced a measured reinvestment program, but we are still sitting with cash holdings in our classic account of greater than 50%. We will continue our watching brief on this issue as the Australian economy evolves. Our preference is to tilt towards a reinvestment, but in a very steady and measured way. Diversification remains a key risk mitigant in our portfolios too. You can see the unrivaled diversification we have here, driven by a number of loans, by average investment size, by largest investment, by sector, and of course, by geography. Zenith Investment Partners has described the 12-month term account as the most diversified portfolio in the sector, and that's a key driver of the low volatility returns our investors have enjoyed for many years. On that note, I'll hand over to Michael Watson, who will do a deep dive into the COVID-19 economic impacts and specifically hardship and arrears management. Michael, over to you.
Thanks, Troy, and good morning all. It's great to be with you today. One of the responses of the La Trobe Financial Group to the coronavirus crisis has been to grant very necessary hardship relief to borrowers who are temporarily unable to make loan repayments because of the coronavirus-related economic hibernation and government shutdowns of various businesses. It's important to remember that this is temporary relief from repayments only, not a debt relief program. Affected borrowers are still obliged to repay their loans in full, including all interest and fees. But this hardship relief does allow an otherwise strong borrower to get through this unprecedented time before resuming repayments. Those who have attended these sessions for the past few months will recall that in March and April, our portfolio managers were stress testing the ability of our portfolios to make repayments with as much as 25% of the loan book not making payments, either due to hardship arrangements or arrears. Pleasingly, it's become increasingly clear month by month that our portfolios are performing substantially better than these worst-case stress test scenarios. From peak coronavirus panic back in March, many borrowers rationally applied for hardship relief to preserve their cash flows. Since then, they've returned to repayments much more quickly than we had expected. From an April-May peak of around 15% of assets under management, hardship loans have declined to 4.1% of fund loans at the end of September. We're seeing very few new hardship claims, although we are unsurprisingly seeing some of our Victorian borrowers seeking extensions, and we're working through these on a case-by-case basis, granting month-by-month extensions where appropriate. Projecting forward, we're anticipating the significant decline in hardship accounts will slow down as the remaining hardship borrowers return to repayments over the next 3 to 6 months. Obviously, we're being sensitive to these unique circumstances, but our priority remains proper management of investor capital. Our guidance back in April and May was that it appeared to be a 2 to 3% transition from hardship to arrears, and that still seems appropriate. We should start to see that play out over the next month or two. So the portfolio's capacity to make monthly interest payments is uninterrupted, and notwithstanding the heightened or elevated hardship numbers, they remain at very manageable levels. This experience is being felt pretty consistently across the fund and each of its investment accounts at present. The composition of our hardship loans is broadly in line with our overall portfolio. There's a slight over-indexing to Victoria, as you'd expect, given the extended hibernation imposed on that economy, but by occupancy type, repayment type, security property location, all is broadly in line with our overall portfolio. Some have asked whether we're experiencing increased hardship in our commercial book. As you can see, we are not. It is in fact our residential book that continues to be slightly overrepresented in the hardship portfolio. Our commercial book continues to perform very well indeed. On the left-hand side of screen, you can now see the hardship levels in our accounts versus those of other lenders. Note that these data prints are very dependent on the report date. Few lenders seem to be rushing to monthly reporting as we have done, and APRA data is lagging by a month. However, it does seem that our portfolios have recovered ahead of the industry, which is perhaps reflective of our more mature borrower profile and our active management of hardship borrowers. Nevertheless, most operators are reporting declining hardship levels month on month, which is a positive for systemic stability. The split by industry sectors shows what you would expect. Hardship continues to be concentrated on those industries most affected by shutdown: food, accommodation services, and retail. Other industries, including the economically important construction industry, have been more resilient, and that's been a real tailwind for our portfolios. We have our portfolio managers continually testing our collateral protection through portfolio loan to valuation ratio positions in light of these hardship claims. On screen, you can see the end of August results for the flagship 12-month term account as our measure here. You can see two things. First, at the top, hardship levels have followed those of the credit fund as a whole and have reduced very quickly in the last few months. Just 3.9% of the 12-month term account is in hardship at the end of September, and this, quite frankly, is well ahead of our expectations. Second, our low loan-to-valuation ratios are very resilient and position us very well to deal with any borrowers who do struggle to return to repayments at the end of their hardship arrangements. On screen, you can see the original LVR position, and on a much more conservative basis, the LVR position based on updated valuations and 4 months of capitalised interest. This shows that, based on current valuations, over 60% of the loans that are in hardship have a current LVR of less than 70%. What's more, this overstates the actual LVRs because it doesn't take into account borrower aheads, hardship completions, and the like. So that's reflective of a strong collateral support position and plenty of margin for safety with our investors. When you think about hardship loans together with our arrears loans, you get a really strong overall picture of the asset performance of the credit fund. I'd like to make the following notes. First, the level of shortfalls we've crystallised over the last 12 months is exceptionally low. Further, our level of provisions drawn for expected shortfalls over the next 3 to 6 months is also very low. Our borrowers are performing very well indeed. Secondly, temporary closures of various state property markets have seen some more aged arrears stay in our book a little longer than usual. This has caused an uptick in 90-day plus arrears, but overall, levels are still within their normal ranges. With these property markets now open again, our collection team is starting to work through this backlog. And thirdly, as I've said, we're expecting 2 to 3 percentage points of hardship loans to transition into longer-term arrears. These borrowers will have seen their circumstances change as a result of the COVID-19 economic disruption, and our collections teams will be working through the implications of that with them on a case-by-case basis. That effect will begin to come through over the next month or two. And turning now to the broader fund context, we're really pleased to report that the assets under management in the credit fund is now above pre-coronavirus levels and is growing solidly each month. As Annie pointed out earlier, we've built a deep reservoir of trust with our investors in this low yield environment, and we are acutely aware that investors are relying on us to deliver consistent monthly income. We note in particular that we've seen investments in our longer dated accounts, the 12-month term account and our 4-year accounts in particular, increase materially over this time. It's our shorter dated accounts, being the classic notice account and our 90-day notice accounts, that have decreased in size. And this has actually increased the average investment tenor of the credit fund by some 8.4%, significantly improving the risk profile of the credit fund. With new account openings now not far off pre-coronavirus levels, our focus remains on continuing to deliver consistent performance and friendly personal service for all of our investors. And on that note, I'll hand back to Chris Andrews to talk to the quarterly economic review and the market outlook for the remainder of 2020.
Thank you, Michael. And thanks to Troy and to Annie for their really interesting insights there. So the Australian economy is transitioning from hibernation to rebound, and the imminent reopening of the Victorian economy is going to be a key milestone in that process. It will, of course, take the proportion of the economy in rebound from 74% to 100%. And that's what's needed for a genuine national recovery and for the commencement of the critical restructure phase, in which we begin the work of clawing back the economic growth that the coronavirus, frankly, has taken from us. This period will be one of hard yards across the economy over what we expect is a 39-month recovery period. We will see lower aggregate demand, lower employment, and lower interest rates through this phase. Investors will experience this as continued challenges in generating consistent real income. So what are the economists saying? The title of this next screen says it all. Economists across the board are continuing to upgrade their outlooks. Data print after data print is surprising on the upside, and this is gradually having an effect on sentiment and the views of Australia's economists. Remember, of course, it was only a few short months ago that economists were projecting 10 to 15% unemployment rates. Those sorts of dire projections have been consigned to history, and there's a growing consensus that we're facing a significant economic challenge, certainly, but one that is considerably more manageable than what we were facing in April. On screen, you can see updated projections from most of Australia's key institutions and economists. There's a growing realisation that the recovery and restructure phases will take some time to work through, and we are likely to see our economy below capacity for some time to come. Now, we've said it before, watch for the molasses economy over the next 12 to 24 months or so at the very least. After all, a standard recovery period for a recession is 39 months. So those expecting a return to normal in say, March next year, you're likely to be sorely disappointed, unfortunately. Our own house views remain unchanged. We're at the bearish end of the spectrum on the table on screen. We're very comfortable to be there. In our view, that's a prudent place to be for a manager who prides themselves really on being conservative and having a focus on capital preservation. Turning to the property market, it continues to be exceptionally resilient, really surprising on the upside. Again, the bet against Australian housing market, it is showing itself to be the classic widow's trade. House prices declined in September, but by just 0.1%. Now that was better than August, which was down 0.4%, which was itself better than July, which was down 0.6%. Every single capital performed better in September than it did in August. And that fact alone shows the strength of the recovery trend that we're seeing. Notably, of our major markets, Sydney is still up 10.6% year on year for total returns. And even Melbourne, with its 6-month lockdown, its 6-month hibernation period, even Melbourne is up 6.7% year on year. So, and I cannot emphasise this enough, there are no signs of disorderly house price reductions. The housing bears have officially capitulated. We can see the improving trends at a national level from the graph on the left-hand side of your screen. And note that the sum total of the last 5 years of house price movements nationally is a very stable average house price. We're also seeing the surprising resilience of sales volumes through this period, and you can see that from the graph on the right-hand side of the screen. Household balance sheets are strong in aggregate, and this delivers incredible stability to the market. The leading indicators for housing are also strong. So whether you look at clearance rates, which are above the decadal average despite the Victorian lockdown. We have the new home sales, which are up, and as we've said before, the property bears are capitulating. Economists across the board are upgrading their predictions for house prices. This is a very solid set of dynamics for house price performance in 2021. So we'll now turn to the quarterly Headwinds and Tailwinds economic report, in which we'll point to some of the key factors currently influencing economic outcomes. As we do each month, we'll focus on some of the more enduring themes here, but as well, we'll look at some of the new and interesting angles and insights. And the first headwind for us to talk about is business investment, which is failing to ignite. Now, at its very simplest, GDP is calculated as consumer spending plus government spending plus investment spending plus net exports. And the outlook for the investment component is on screen. In our latest federal budget, the outlook, in fact, is dire. ABS survey data has indicated that expectations for non-mining investment have deteriorated for this financial year, with businesses deferring or cancelling non-essential capital investment. Overall, non-mining investment is forecast by Treasury to fall by a whopping 14.5% in financial year 21, before growing by 7.5% and 7.5% in financial year 22. Mining investment grew for the first time in 7 years in financial year 2020, and it is expected to grow by a further 5.5% in financial year 21. Industry consultation and recent capital expenditure data has indicated to Treasury that investment in large iron ore projects is expected to continue, and that will be, of course, to sustain the productive capacity and maintain the really large capital stocks that have been accumulated through the investment boom over the last decade or so. However, mining investment growth is forecast to be weaker at 1.5% in 21-22, and that's, of course, as global uncertainty and lower demand for some commodities has led to deferrals of investments for new and existing projects for other major commodity exports. And this is going to weigh on GDP over at least the next 2 years. The second headwind is population growth, and it is really plummeting back to earth. Australia's population growth, in fact, is expected to slow to its lowest rate in well over 100 years. So that's all the way back to World War I, falling from 1.2% in FY20 to 0.2% in FY21 and 0.4% in FY22. This slower growth is, of course, mainly due to measures taken to limit the spread of COVID-19, which in turn leads to net overseas migration falling from around 154,000 people in FY20 to around 72,000 in FY21 and then to around 22,000 in FY22. Now, when you do the sums, when you add up those numbers, there are going to be 402,000 missing Australians in just 2 years. And put this in context, Australia lost 62,000 people in World War I. It was on a much smaller population base of just under 5 million, of course, but even allowing for population size, the permanent loss of human capital from the coronavirus is 33% higher than it was from World War I. Now, obviously, we're not talking death tolls, which is a very critical point, as we were in World War I, but the negative net overseas migration level leads to a permanently lower level of population and a permanently lower working age population. And that's as the chart on the right-hand side of the screen shows. We are experiencing a permanent population loss, and that is a real headwind for our economy. The third headwind is Victoria, Australia's recalcitrant state, and its deadweight effect on the national economy. The graphs on screen show the impact that stage 2 lockdowns are having on the 26% of the national economy that is what we call Victoria. There's no doubt that these impacts are also reflecting indirectly in softer confidence and activity in other states, which is why, of course, it's so critical that Victoria moves as quickly as possible back into the rebound phase, not just for Victorians, who will certainly welcome it themselves, but also for the national economy as well. The final headwind is the widespread set of problems across the economy. Wherever you look across the economy, you can see the fundamental headwinds caused by the coronavirus. Company insolvencies have been held artificially low by changes to the Corporations Act, but they will rebound when those changes are reversed. Vehicle registrations have dropped off a cliff. They then rebounded, they've dropped off again. High frequency data on payroll jobs shows substantial drops across most industries. This is the sort of thing that the restructure phase will have to address, and it will be challenging, make no mistake about that. But there are tailwinds for our economy as well, and some of them are putting a real jet engine under the Australian economy. The September federal budget was effectively a declaration that the federal government will do whatever it takes to nurse the economy through the coronavirus event. Now, that phrase, of course, was the famous declaration by European Central Bank Governor Mario Draghi in 2012. Following the Reserve Bank's lead declaration in its October meeting that reducing unemployment will be a national priority, the federal government's FY21 budget committed to full support of the economy until Australia's unemployment rate is below 6%. In FY21, that means a whopping $213 billion deficit, which is around 11% of GDP and the largest deficit since World War II. Net debt is now projected to rise by $475 billion to a total of $966.2 billion over the 4 years to 2024, which is itself, or will be at the time, 43.8% of GDP. Now, as you can see from the graph on the right-hand side of the screen, we're better placed than most nations to respond like this because we are beginning in a relatively strong financial position. The government's centrepiece policies target businesses, they target households, particularly via income tax relief and infrastructure. No substantial economic reform packages have been announced to date, although we do expect the next 12 months to be what we might call a policy-rich environment. So watch your screens for more details and announcements from our federal and state governments there. Now, we saw last month that our banks are awash with cash, and that's given record deposit levels and the incredible $300 billion term funding facility, which the Reserve Bank is making available to our banks. A surprise tailwind comes from how resilient household finances have been through the hibernation phase, and that's thanks in large part to government support for the economy. Disposable income was up 2.2% in the June quarter, and the savings rate increased an incredible 15% to a whopping 19.8%. Really, really high savings rates there. Early access to superannuation funds, so those withdrawals have topped $34 billion in aggregate, but have now in more recent weeks slowed to a crawl. And that, of course, is reflecting the fact that most of Australia is getting back to work. Overall, household wealth is only down slightly from the record heights at the end of 2019, and that's a strong tailwind for the Australian economy. The third tailwind is consumer sentiment, and that has recaptured altitude at a very rapid pace. It has to be a surprise that in this environment, we are seeing consumer sentiment readings above the long-term average. And I say that again, above the long-term average. The best read on that is that consumers are feeling the wealth effect of excess savings, high deposit rates, income increases, tax cuts, and all of that in aggregate is driving a really strong surge in consumer sentiment, which is a very strong positive for the medium-term consumption outlook. Unemployment expectations data, they're volatile, but they certainly dropped dramatically in October by 14.2%. So consumer sentiment is surprisingly robust. Finally, if there was any doubt about the unanimity of our policymakers about the extent of the challenge and their willingness to lean in to meet it, take a look at the recent statements from the Reserve Bank. The afterburners for the economy are about to kick in. Governor Lowe has flagged at least 3 key changes to monetary policy settings. First, Governor Lowe has been saying for months and months, if not years, that the official cash rate is already at its zero bound, effectively the lowest rate to which it can go. Well, Governor Lowe has now foreshadowed a 15 basis point official cash rate cut in November. And we have our doubts, of course, whether this cut in itself will have any stimulatory effect, but it is certainly the case that the Reserve Bank is redlining its official cash rate mechanism to support the government's fiscal policy. Likewise, the $300 billion 3-year funding facility for the banks, the term funding facility, that's likely to have its interest rate cut from 0.25 to 0.15%. Our financial system is and will continue to be awash in very cheap, very stable money for our banks. Finally, and perhaps most surprisingly, Governor Lowe has undertaken to move the Reserve Bank's bond buying program out the duration curve and beyond 3 years. This is going to put substantial downward pressure on long-term interest rates, particularly for corporates. So the federal government is all in. The Reserve Bank is all in. This is a serious tailwind for the Australian economy. And that's really the note I'd like to emphasise by way of summary. The headwinds are real and they are substantial, and recovery will be neither quick nor easy. But our policymakers are treating this situation as the unprecedented emergency that it truly is until we establish a substantial, long-lasting COVID normal. The global economy will require significant policy support. And our policymakers here in Australia are clearly saying that they have the will to do whatever it takes. And don't underestimate the Australian economy either. In case we've forgotten how well we've fared to date on a relative basis, you can see on screen the same chart as we've showed over the last couple of months, but with IMF economic outlook data, which has just recently been released for 2021. We've included that on the screen as well. Australia's real GDP outcome through the coronavirus was among the best in the world. In the March quarter, when the pandemic first hit, we outperformed the world, and this resilience has continued into the June quarter as well. Take a look at the UK, down 22% in aggregate. GDP down 22% in aggregate. France is down 19.7%. The US down 10.4%. Now, because we in Australia didn't fall so far, our 2021 outlook won't show such a dramatic rebound in economic growth. But in aggregate, we are a long way ahead of most of the rest of the developed world. Let's conclude by way of summary, as we always do, with a quick summary of the sector and any topical issues that are arising via our key issues. And we start with corporate financials. Look, we expect to be profitable and cash flow positive through the coronavirus event. We have a very strong balance sheet and net asset fundamentals, as you heard last month from our CFO, Martin Barry. We're not anticipating any rush to capital raising. We're well positioned to meet any issues arising in the current environment. We have built our business as we've built our portfolios to be resilient to market volatility and the economic cycle. So the outlook here is stable. Liquidity management, second issue. And look, as Troy Stratton said, our Deputy CIO, our liquidity fundamentals remain strong. Assets under management are growing month on month. Our short-dated accounts remain substantially overweight cash. Tactically, we're shifting to a reinvestment bias, and we're doing that in line with our guidance to investors over the last few months, but we will continue to monitor market developments very closely. We do reserve the right to adapt this tactically as conditions evolve. Specifically, should there be a need to increase cash holdings in any point, second wave, market volatility and the like, we continue to be well positioned to do so. Our commitment to you, our investors, is that we will retain a contingent liquidity plan that provides us with lots of flexibility, plenty of optionality, and the ability to manage a range of market conditions. Our track record, remember, is that we have always paid redemptions in full at maturity, and we see nothing that will change that. So again, the outlook is stable. Third issue is the official cash rate and interest rates. Now, look, our portfolios have been resilient to cash rate decreases and investors have been substantially shielded from these over an extended period. So over the last 5 years, the official cash rate has reduced by 1.75%. 1.75%. By contrast, the 12-month term account, its distribution rate has come down just 0.70%, 0.7 of 1%. As we've discussed, Governor Lowe has flagged a change to his previous position that the official cash rate is already at its lowest possible setting, the zero bound. We're now expecting a 15 basis cut to the official cash rate in November. If and when that occurs, we will go through our normal monthly process of evaluating the effects on borrower rates and the income generated by our portfolios. Now, our modelling continues to indicate that the current rate settings are at broadly sustainable level given the medium-term portfolio income profile. We will continue to fight for every basis point of return for you and for all of our investors in this very low interest rate environment. We turn now to borrower hardship. We had a really good summary on this issue today from Michael Watson. In summary, we're seeing material improvements in borrower hardship levels. These are occurring significantly ahead of our own expectations, which is obviously very pleasing. Our hardship and collections team will be working very closely with our borrowers on a one-to-one basis to establish a clear return to normal repayments. Indications from our assistance program is that 2 to 3 percentage points of borrowers will transition to workout. It could be slightly higher, could be slightly lower, depending on a number of variables. We will be working sensitively and carefully with those borrowers, but our priority, of course, as always, is return of capital at all times. Importantly, remember, hardship arrangements are themselves subject to a responsible lending overlay. They're a bridge through difficult times, not a debt forgiveness program. So overall, we have our hardship portfolio listed as improving. And portfolio arrears loans levels remain broadly consistent with historical expectations and historical experience across our portfolio. We've seen somewhat elevated levels in the more aged brackets over the last few months, as Michael outlined, and that's of course because there's been a delay in taking some mortgagee in possession properties to sale, with property markets temporarily closed in the hibernation phase. We'll be watching those numbers carefully, but are not seeing or expecting any undue hardship or portfolio stress there. Our collections team are, of course, well versed with working with borrowers in difficulties and working through periods of market stress. Again, we will be compassionate to borrowers in difficult circumstances. We will have regard to the unprecedented economic shock caused by the coronavirus, but ultimately, our focus will remain properly on calling up loans where borrowers' circumstances have changed and they're unable to meet their loan obligations. We make no apologies for that. It is our duty as a manager. So the outlook here is stable. Turning finally to the sector overall, we're seeing continued strong fundamentals across the system here. Look, Governor Lowe's speech was something of a game changer for policy settings, as we discussed. It was his own mini Mario Draghi moment, if you like. We've discussed the term funding facility and the impact that these lower rates could have on bank balance sheets and systemic liquidity. We're now starting to see increased drawings on the term funding facility. So those drawings started off slowly, but there's been 82.9 billion drawn by the end of September, and that is a material amount of liquidity being injected into the Australian banking system. The Australian Office for Financial Management has continued to deploy the Structured Finance Support Fund, although it has been doing that at a much slower clip than originally expected. And we've observed that before. It's interesting how strong the non-bank financial institution sector has been through this coronavirus period. And really, that's an endorsement of the policy settings of the government. The AOFM has deployed $3.6 billion through this Structured Finance Support Fund, mostly to support warehouse facilities. I should point out that the AOFM supported 12 transactions in the September quarter. And in fact, La Trobe Financial's $500 million issuance was the only case in which an eligible non-bank issuer did not seek the support of the AOFM. So that's testament, of course, to the great work of our Treasury team, but also the considerable reservoir of trust that we've developed with institutional investors over many, many decades. The AOFM was also busy with a further 2 forbearance facility applications being approved, and that brings the total approved amount to $98 million. So that facility, of course, supports lenders who have substantial cohorts of borrowers experiencing hardship. Now, this facility is open to La Trobe Financial, of course, but our lower hardship levels mean that we have not applied for the forbearance facility at this stage. Overall, markets have been surprisingly resilient through this period. That's a theme that we continue to repeat, and it's reflected in spreads and volumes across the market. Our banks are very well capitalised. They're well regulated. We've had really innovative policy making, and in fact, it's interesting, the very willingness of our regulators to step in and the very clear signalling they've given around that has meant that in many cases they actually haven't had to step in, or have only had to step in a minor way. So we're looking at a strong and prospective market as we head towards the end of the year. And on that note, I'll turn to questions. So bear with me as we call up the questions on screen. And the first question is from Carol. So this was submitted before the presentation. Thank you, Carol. Carol is asking about our forthcoming 6-month and 2-year investment offerings. Great question. Yes, thank you, Carol. Troy Stratton and Annie Sestito, from both of whom you've heard from earlier, are working really hard at the moment. They're overseeing the introduction of some new investment offerings for our investors, the strategy and the portfolio settings. So the assets we're investing in, the portfolio parameters, the disciplines around those offerings, they'll be very much in line with what you're seeing in our existing offerings, our classic notice account, our 90-day notice account, and our 12-month term account. The investment terms that we are targeting are a 6-month investment on a notice basis, so a 6-month notice account, and a 2-year term investment offering respectively. We're targeting launch in November or December, and that's subject to finalisation of the necessary due diligence and legal requirements. And at the time of launch, we'll be able to announce the rates that those funds will be launched at. So thank you, Carol, for that question. And if you can bear with us, we should have these new offerings in market in the next month or so. The second question is from William. William has asked about the changes to the responsible lending obligations. Yes, so Treasurer Josh Frydenberg has announced changes to the responsible lending obligations, and William is asking about the implications for La Trobe Financial. Great question. Really interesting discussion piece here. Could in fact, William, be a webinar in itself. Really at the heart of the issue of credit regulation is how far, on the one hand, how much emphasis should be placed on responsible lending by the lender, caveat venditor, as lawyers would say, versus how much emphasis should be placed on the borrower, on responsible borrowing by the borrower, or caveat emptor. The federal government has recently announced that it will seek to simplify credit regulation by the unwinding of the responsible lending obligations in the National Consumer Credit Protection Act. Now, I pause here for a moment. This doesn't mean, and it is critical that you follow this, it does not mean that lending will be unregulated. The announcement stipulated that the APRA standards outlined in APG 223, APRA's guidance on residential mortgage lending, those standards will continue to apply, and in fact, key elements will be extended to include non-bank lenders. What's more, there will be now imposed new overarching requirements on lenders via the design and distribution obligations, which will require lenders to ensure that all of their products are suitable for their target markets. So lending is hard-baked in Australia, frankly, as a highly regulated activity. And again, just as frankly, we don't mind that at La Trobe Financial. It is, in our view, appropriate that there be proper regulation around the financing of what is, after all, likely to be the most significant and costly purchase in most people's lives, their family homes. Now, there's a lot of detail to come about Treasurer Frydenberg's proposals. There will be a lot of water going under a lot of bridges. There'll be obviously debates in Parliament and in the Senate about getting the settings on these new credit regulations right. And we'll need to see that before we can precisely measure the new regulatory framework and what its impact will be. But our initial view is that its impact is unlikely to be significant. Obviously, we comply with the existing framework. Any simplifications, I guess, in process that we can adopt, any efficiencies, obviously that will be useful for us at the margins. But since these credit regimes apply across the industry to lenders everywhere, and also given the weight, as I've said, of existing regulation and new regulation that will continue to apply to banks and lenders generally, we don't see a substantial change in competitive dynamics. I'll leave it there, William. Really interesting discussion. We will return to this topic in future webinars, obviously, as more detail is released by the government, but that's our early assessment of the impact of those changes. Jane, so I'm looking at a question from Jane, who is asking whether our offerings, in summary, are guaranteed by the government. And the answer is no, they're not, Jane. La Trobe Financial is not a bank. We're not regulated by APRA. And as I never tire of saying, our offerings are not guaranteed. They're not subject to the federal government bank deposit guarantee scheme. Further, we have no intention now or in the future to become a bank. Banks are subject, of course, to the federal government's bank deposit guarantee system. So deposit rates benefit from that, but deposit rates are also unsurprisingly extremely low. In fact, they've been consistently lower than inflation over a medium-term view. And that means that investors who are leaving their money in the bank are actually losing capital value by doing so. Our approach here at La Trobe Financial is fundamentally different. We are an investment fund. Our objective is to deliver consistent, real monthly income, and we want to prioritise the preservation of investor capital. So none of our portfolios, and by that I'm referring to our classic notice account, our 90-day account, our 12-month term account, our 4-year account, none of those accounts has ever lost a cent of investor capital. Likewise, we've never lost a cent of capital for any of our institutional investors, and that's over a 7-decade timeframe. That sort of powerful track record is one that we're proud of, but it's one also that we are entirely focused on retaining. So for people who are considering investments in our credit fund, I would encourage you to review our investments in great detail via our website and our monthly portfolio report that Troy Stratton spoke to so ably earlier in the presentation. Just time for one or two more questions. We have a question from Michael asking about whether there has been any uptake in foreign borrowing from La Trobe Financial. So by that we mean people coming to Australia, non-residents of Australia looking to purchase. Yes, there is always a small component of that in the Australian lending industry. And Michael, we do continue to see some of that here in Australia. There was a sort of a surge in non-resident borrowers in Australia, particularly for the Sydney and Melbourne markets in 2015, 2016. That was a sort of a short-lived spike though, and we're back to sort of the small, normal, sustainable levels that we would expect to see in the banking system across the longer medium term. I have a question from Richard asking specifically about the 12-month distribution rate. Will it continue at 4.5 or will downward pressure cause a reduction? So Richard, we talked a little bit about the dynamics in interest rate markets at the moment. Currently, our modelling is showing us that 4.5% is about the right rate for the 12-month term account. There are downward pressures on interest rates, so we will continue as we always do, regardless of what's going on in the economic cycle. At La Trobe Financial, every month we go through a very disciplined process of modelling the medium-term income profile of the 12-month term account, and indeed our other accounts, and to determining whether they are appropriate given all the market dynamics that are prevailing at that time. So our current view is our setting's about right, but obviously it's a month-by-month proposition, as it always is. We will continue to review that on a monthly basis. So no changes to foreshadow for you at this stage, Richard. And the last question from an anonymous attendee, so we'll finish up here given the time that we're running short on, and there's a question about the weekly shopping list and can we get some more investments onto the weekly shopping list? Yeah, look, great question. You will need to bear with us on that. We are at the moment experiencing enormous demand for our peer-to-peer investment offerings. And given that property markets, remember, just 3 or 4 months ago were closed across Australia, there is just a temporary pause in approved loans coming through. We are seeing those volumes pick up again. And over the next 1 month, 2 months, 3 months, you will start to see that flowing through onto the shopping list. But I do apologise for the temporary pause. And that was, as I say, caused by the temporary pause in overall credit regulation. So on that note, we're out of time, so I will finish up there. Thank you once again for your attendance and interest in our credit fund. It's our pleasure to be able to assist you with your investments and a really terrific opportunity to present to you the broader La Trobe Financial executive team as well. So for now, I'll pass back to Bridget to wrap up this morning's proceedings.
Thank you, Chris, and to Annie, Troy, Michael, and to all of our attendees. Thank you once again for joining us today and for your continued interest in La Trobe Financial. Please stay safe and well, and we look forward to your company at our next monthly investor update in November. If you have any questions we didn't cover today, please contact our investor team on 1800 818 818. On behalf of all of us at La Trobe Financial, we wish you a great month ahead.